Welcome to the Deep Dive. We're here to cut through the noise, bring you the sharpest insights. Look, you want to be in the know, right? But who has time to sift through mountains of info?
Exactly. So today we're giving you a shortcut. Think of it as the highlights reel from the 2025 Berkshire Hathaway annual shareholder meeting Q&A.
You get to hear straight from Warren Buffett. Absorb Charlie Munger's wisdom, though. He wasn't speaking in these specific clips, and really get Greg Abel's vision.
Yeah, they covered a lot. Everything from global trade, investment strategies, to, the cutting edge of AI.
And this wasn't just some casual fireside chat.
Not at all. It was shareholders from all over the globe asking tough questions. It was a real deep dive into economic currents and how Berkshire's planning to navigate them.
So our mission today, pull out the key knowledge, the surprising bits, those aha moments for you.
Right. All curated for you, the curious mind, without getting bogged down in, endless detail.
Okay, let's get straight to it. First big topic, trade deficits. And Buffett's older ideas about something called import certificates.
Yeah, this came up back in 2003. He had this concept. The goal was basically to try and balance trade.
Level the playing field a bit, especially for developing nations.
Sort of, yeah. Help them catch up. His core idea, and he seems pretty consistent on this, is that more balanced trade is generally better for the whole world.
He used an analogy, didn't he?
He did. Something simple like trade between Con and Colombia, specifically coffee, just showing how exchange can benefit both sides.
It's a straightforward idea, but with big implications.
It really is. And the key insight is this long-held belief in balanced trade, but also, the understanding that even good ideas face hurdles in the real world.
He also talked a bit about America's own economic path.
Right. From, non-existent to agricultural, then a huge industrial power.
But now he seems worried about the U.S. trade deficits, the debt.
Yeah, there's a definite concern there about the long-term health. He used the phrase winning nation for the U.S., but then immediately questioned if it's appropriate or even smart if large parts of the population are struggling while a few thrive.
So broader prosperity makes everyone safer. That's the idea.
That seems to be the connection he's making. Prosperity achieved through good trade, not at others' expense.
And the import certificates themselves. He had a funny description.
Oh, the Rube Goldberg analogy. Yeah, suggesting it might have been, overly complicated or maybe just impractical.
And it never really took off, did it?
Nope. He mentioned printing extra copies of the article explaining it, but there was just no demand. It really shows how tough it is to put economic theory into practice.
And he was clear. Trade shouldn't be a weapon.
Absolutely. That came through strongly. The underlying message is really about how interconnected the global economy is and the dangers of, protectionism.
Okay, let's shift gears. Something that did work out well. Berkshire's investments in Japan.
Oh, yeah. That's been a real success story over the last, 5 or 6 years.
What was the initial attraction?
Well, this is classic Buffett.
Yeah.
He apparently went through some huge handbook of Japanese companies. You know how he absorbs data? And he spotted 5 specific trading companies that just looked incredibly cheap. Ridiculously undervalued, I think was his word.
Based on their real worth versus the market price.
Exactly. Not just a hunch. Pure value assessment.
And it wasn't just a quick look.
No, no. He said after about a year of digging deeper, they were convinced. So convinced, they actually started buying shares before getting the company's formal okay.
That's bold. And now there's talk about maybe easing restrictions on foreign stock buying over there.
It shows real confidence in their analysis, doesn't it? And this isn't some short-term play. They plan to hold these for, 50 years.
50 years. Wow. Not selling in the next decade even.
Serious long-term commitment. It's based on the history and fundamental strength of these Japanese businesses.
He also mentioned getting good feedback from big names. Apple, Amex, Coke, all doing well in Japan.
Yeah, he did. Apparently, Japan has unique consumer habits that really favor certain products, and their distribution is supposedly top-notch.
So it's not just numbers, it's understanding the market on the ground.
Precisely. And it's not passive. Greg Abel mentioned they talk with the management of these companies regularly, maybe once or twice a year.
Abel sounds positive about it too. Sees future global potential.
Very positive. And Buffett himself stressed the different business culture in Japan. It's not just like investing anywhere else.
The initial investment was huge, right? $20 billion?
Around that, yeah. And he joked he wished it had been $100 billion. Plus, they're actively looking for more opportunities. There are bigger acquisitions, maybe standalone ventures.
So it's about listening, acting, even if it's not perfect at first.
That seems to be a core principle. Deepen the ties, learn as you go. He used Coca-Cola's Georgia coffee in Japan as an example of needing to understand those cultural differences.
You really have to dig into every page of a company's operations to find that best recipe, as he put it.
That's a great phrase for his meticulous style, isn't it? Really digging in deep.
Okay, let's talk about that cash pile. $300 billion.
Yeah.
That number just jumps out.
It's staggering, isn't it? Historically, their average cash holding was, what, maybe 13% over 25 years? Now it's way higher, about 27% in short-term stuff.
Giving them massive flexibility.
Huge flexibility. But Buffett described their approach as retention, basically being ready to pounce when something really good comes along.
Something they understand well, offers value, and crucially, no fear of missing out, no FOMO.
Exactly. He made the point that those truly classic, amazing investment opportunities, they're actually quite rare.
And they have a long history of being careful. He mentioned something like 16 million transactions over 80 years.
Yeah, they're not rushing. He even set a high personal bar, like needing a hypothetical $50 billion deal to really make a dent for Berkshire now.
And avoiding the danger of investing just because the cash is burning a hole in their pocket.
Right. Especially with, what, $40 billion flowing in each year? The pressure must be immense.
But they're resisting. He said, not every day is the same expectation for finding great deals.
Wise words. It takes careful listening, filtering out the noise, finding those jewels, as he called them. Well, it could take 5 years, could take 50.
But he did sound hopeful that something big could happen in the next 5 to 15 years.
He did leave that door open, even if it's not immediate. Like finding a needle in a haystack was the analogy.
Yeah, emphasizes the difficulty.
Definitely. Scarcity and a lot of searching required.
Okay, so moving from cash to assets.
Yeah.
What about real estate? Buffett seems to find it trickier than stocks.
Yeah, it was interesting hearing him compare them directly. He pointed to the extra layers in real estate, more communication needed, complex negotiations, often loads of people involved.
It's just less liquid, more involved in the stock market.
Totally. He even mentioned Charlie Munger, who had tons of real estate experience, but eventually preferred stocks or other businesses.
Why? The constant choice in the stock market versus fewer chances in real estate.
That seems key. Think about the volume billions traded daily in stocks versus maybe big but infrequent real estate deals.
Plus, the longer timelines and negotiations in property deals. Less appealing, maybe.
Especially, as Buffett noted, at his stage of life. He even brought up some tricky historical deals, like a California development in the 60s that needed major restructuring.
Compared to stocks, where you can sell thousands of shares in seconds if the price is right.
It's a stark contrast. The whole process of negotiating and closing a real estate deal versus a quick stock trade just highlights the friction, the complexity. He used Musk buying Twitter, now X, as an example, billions of dollars, but still needed many parties and took time.
The core takeaway seems to be Berkshire's preference for liquid assets with easy choices, which stocks offer.
Absolutely, compared to the complexities and, frankly, the illiquidity of real estate.
Let's tackle a topic that's everywhere. AI. Artificial intelligence.
Right. And what's interesting here is Ajit Jain's perspective. He seems really convinced AI will be a game changer.
Especially for insurance, changing how they assess and price risk.
Fundamentally, yes, that's a big statement from him.
But Buffett sounds more reserved.
Yeah, he observed how people and companies tend to chase the next very fashionable thing. Berkshire's play seems to be wait. Wait until the picture is clearer before diving in with big money.
Let individual companies figure out the problems first.
That seems to be the idea. Berkshire isn't making huge investments in pursuing AI development right now. They'll jump in, as he put it, when the time's right and the opportunities are clear.
He even deferred to Ajit Jain on the insurance side of things, right? Said he wouldn't want to develop everything around AI himself.
Exactly. Clear division of expertise. He trusts Jain's judgment in that specific area. And interestingly, Buffett mentioned if he had to invest the cash pile somewhere, his preference would be the insurance business.
Believing Ajit's moment with AI will come eventually.
Yeah, that was the feeling. Patience, again.
Okay, here's a fun one. The Chicago hot dog company acquisition. Buffett didn't know about it.
Huh. Yeah, that was quite a moment. His surprise suggests it was probably a decision made lower down, maybe by Greg Abel, or even at a subsidiary level.
Abel's response was pretty quick-witted, too.
Need to call a friend, yeah. It really just highlights how huge Berkshire is. So many companies, subsidiaries of subsidiaries. Complete oversight is just impossible.
Buffett mentioned reviewing 50, 60 reports a month. And over 100 under just one umbrella, Marvin.
Gives you sense of the scale, right? And then we got that interesting history lesson about Marvin, Rockwood Chocolate.
And the 1954 tax law change affecting cocoa prices.
Right. And Buffett's early involvement, even as a 24-year-old, in a meeting about splitting the company to leverage that tax change.
He described the meeting as a bit chaotic.
Sounds like it. And Rockwood eventually became Marvin, which then diversified wildly, winning the first Indy race, inventing the rear-view mirror. Amazing diversification.
Abel eventually figured it out, though. The hot dog company, Bush Partner, was likely bought by Peter Eastwood, head of a subsidiary.
And Buffett used that whole Rockwood story as a paragon, his word for how Berkshire operates, adapting to change, like those tax laws. It's about that long-term opportunistic view.
Let's zoom out again. America's economic tailwind. Someone brought up their belief in its long-term power.
Yeah, a fundamental question. Is the U.S. economy still on that upward path? Buffett acknowledged huge changes happening now, so pessimism or optimism.
His take seemed to be historical context. America's always gone through massive shifts, right?
Exactly. Agrarian to industrial, huge social changes, constitutional shifts. He used women's opportunities as one example of progress over centuries.
Considering the U.S. isn't that old, since 1776, the progress is pretty remarkable.
He made it personal, too. Born when the U.S. was a much smaller slice of the global pie compared to now. He felt lucky, frankly, being born male in the U.S. at that time.
And thinking about everything the U.S. has weathered since he was born in 1930, Depression, World Wars, the atomic bomb.
Right. His overall feeling. The U.S. is a very fortunate country, and he feels personally lucky. It provides that long-term perspective, that sense of resilience.
That perspective is valuable when things feel uncertain now.
Definitely. Having seen so much change gives a different lens on current events.
Okay, patience. We hear it's key in investing. But Buffett added a twist, right? Need for speed sometimes.
Yes, a crucial nuance. It's not just sitting around waiting. It's being ready to act fast when a truly great opportunity pops up. He told that story about Ben Rosser back in '66.
A business for sale looked cheap.
Very cheap. Assets worth $8 million, earning $2 million pre-tax, selling for $6 million. But there was hesitation. Looking into the seller's motives, she was a widow.
Then someone else called, highlighting potential biases. Stereotypes clouding judgment.
Exactly. A guy named Will Phillips pointed out they might be discounting it because of East Coast versus Midwest perceptions. The takeaway was, these amazing chances can appear out of nowhere, and if they're solid, you have to grab them now.
So patience has a mixed character, he said. Patient waiting, then decisive action.
Right. And remembering that current assets, current opportunities, they don't last forever.
Greg Abel reinforced this for managers too. Patient, but ready to jump.
Be patient, but when opportunity knocks, act fast. Don't let self-doubt make you miss it.
And it's amazing, Buffett at 94 still loves the work. Not for the money, clearly.
Driven by helping others, the enjoyment of the game, you could say. And he stressed partnerships, trusts like his long collaboration with Munger. That's key to how Berkshire runs.
So the bottom line, if it's a clear winner, don't wait. Act.
Precisely. Recognize those rare moments and have the guts to move.
Let's talk Geico. They apparently face some modern crises.
Yeah, and Ajichin's view was interesting. He credited another manager, Ted, for turning those challenges around.
What were the main problems? Rates and underwriting.
Two things, mainly. Their rates weren't competitive anymore, and there were worries about their underwriting calculations from like 5 or 6 years prior.
And they acted quickly, adjusted prices.
Yep, rapid adjustments to match competitors, and fixing the underwriting. That had a huge financial impact, like a $2 billion annual swing, apparently.
Wow, so now they're competitive again. Good combined ratios.
That's what Jane indicated. A big turnaround, leading to substantial profits in auto insurance now.
But no resting on laurels. They're looking at AI now.
Right. Not just to catch up, but to potentially get ahead, that proactive mindset.
Buffett seemed to find the whole business development process fascinating, each company unique.
He did. And he reminisced about buying Geico way back in '71 for $50 million. Look at it now, wholly owned, huge earnings.
And the auto insurance industry itself just exploded over the last century or so. Geico's float is massive too, $29 billion.
It's huge. And fascinatingly, the core product from 1936 accurate pricing is still fundamental, influenced by USAA, regulations, of course. He even told a story about a non-actuary employee who had great insights and later founded his own successful company.
Shows that good ideas can come from anywhere. But companies can get distracted sometimes.
Yeah, lose focus. But Geico got back to basics. Buffett often mentions Lorimer Davidson, an early Geico figure, at these meetings.
It seems luck and meeting the right people are big themes for him.
Definitely. Like Berkshire's board members, Tom Murphy, Bill Gates, invest in talented people for the long run, enjoy working with them, listen to the experience, folks. Seize those lucky breaks.
Succession planning, always a hot topic for Berkshire. Buffett compared it to Apple jobs, created it, Cook runs it well.
Right. And the big question, why is he so sure Greg Abel, who seems, normal, will be a great CEO for decades?
What was his reasoning?
He talked about the terrific group of people Berkshire has in capital allocation, said it's rare, hard to build, trust and shared responsibility are key.
And Buffett sees his role now as more of a judge, looking for problems across the businesses.
Sort of. He also mentioned being impressed by the enthusiasm he saw at the shareholder exhibition, people working hard without direct reward. That culture matters.
He also really stressed enjoying your work, his own positive experiences with bosses before starting out.
Yeah, his advice was, follow your early interests, don't stay in jobs you hate long term. He used that great music analogy like Glenn Miller finding his band's sound. You find work you love and want to keep doing it.
Finding something you enjoy early, pursuing it, not obsessing over the first paycheck.
And choosing your company, your boss, carefully. Avoid situations that just feel wrong.
So the plan is to hand the baton to Abel.
That's the intention. He acknowledged Berkshire's huge scale, the future's uncertainty, and that financial principle again. You only need to get rich once. Don't take crazy risks.
He warned against speculators borrowing heavily, hoping to find fools. Said consequences eventually come.
Right. Buffett seemed very content with his life, wishing he could restart with his current knowledge just to pursue his passions more.
And Abel came across as humble, appreciative.
Very much so. Appreciative of Buffett, Agent Jane, saying Berkshire's a great place to work. Buffett ended that bit by saying opportunities, even personal ones like finding a partner, will eventually appear. Sometimes patience pays off.
Currency risk, that's a big one for a global company like Berkshire. How do they manage the dollar potentially weakening?
Yeah, this came up especially regarding the dollar versus the yen, given their big Japan investments. Buffett noted Japan's different monetary policy.
And Berkshire holds lots of foreign currency securities, but their hands are tied somewhat by local policies.
Exactly. They can't just hedge everything easily. Those fluctuations show up in the quarterly reports, obviously.
He tackled the hypothetical, what if they'd foreseen the currency swings?
But stressed they have to report based on actual accounting. Their focus is long-term performance 5, 10, 20 years out. Trusting the management of the companies they own is crucial.
So the yen's movement might add or subtract from earnings on paper, but doesn't change the core business value.
That was his point. Currency depreciation is a factor, but not something to cause panic. Not like, we're going to hell, I think he said.
External factors like government policy matter, but the focus is long-term results.
Right. He expressed confidence in the U.S. economy's resilience and believes nations can ultimately manage their currencies, even if things get rough sometimes.
And speculating on currencies isn't as appealing as putting capital to productive use.
Far less appealing. He acknowledged the difficulty of balancing currency values globally, the need for checks and balances. Best to look at long-term outcomes, not short-term swings.
He mentioned historical inflation, like after WWII, as things that aren't permanent.
Yeah. And Greg Abel added that the underlying performance of their Japanese companies has been strong regardless of the yen, and they see more opportunities there.
Buffett brought it back to basics. Currency is a factor, references old writings. Even Bitcoin came up. Munger thought non-security investments could work too.
But the outlook for big profits from currency speculation short-term, not great. Their plan is to hold their positions, keep favoring the U.S. for investment overall, and expect satisfactory results long-term, despite the currency noise.
Okay, how about emerging markets? Specifically, Mongolia got mentioned.
Yeah, a listener brought it up. Growing market, interesting location between China and Russia, livestock, mining.
Buffett's reaction.
Started with a lighthearted comment about wanting to visit Casablanca. He knew of Mongolia's progress from a meeting years ago, but stressed the need for solid government reports and real practical business opportunities before Berkshire would even consider it.
They're hesitant to signal interest in a country without truly significant potential.
Very hesitant. And they don't buy the idea that high inflation periods are the best time to find deals. No short-term plans for Mongolia unless something massive that fits their scale pops up.
Though maybe 20 years ago, things might have been different.
Possibly, if conditions were right then. He acknowledged Mongolia's reputation and business environment are important factors, but admitted uncertainty about the specifics of its economy.
His goal isn't perfection, just doing better than others, starting from scratch.
Right. And he finished by noting the U.S.'s huge share of global GDP now and wishing Mongolia well. It really shows their disciplined, scale-focused approach to going international, not chasing every trend.
Need those specific, substantial opportunities. Okay, competition. Private equity firms are moving into insurance more aggressively, holding permanent capital, competing with Berkshire. Impact.
Ajit Jain tackled this directly. His view. If PE wants in, Berkshire might not always win on price, but Berkshire's performance has been very strong. He separated their P&C insurance from other businesses.
Why are PE firms so interested? Good economics, safer assets.
Seems to be it. Stable sector, perceived safety, but they're also pushing for higher returns. That push, though, might run into regulatory concerns about risk-taking. That could be a stopping point.
And Berkshire's stance, stick to their risk profile.
Pretty much. Willing to wave the white flag, as Jane put it, rather than compete in deals they see as too risky. Buffett added an interesting point. Imitators often miss key parts of the Berkshire model, like CEO pay structure.
Different equations, different contexts matter. Not everything is replicable.
Right. Levels of loyalty vary. Some approaches work, others don't. For Berkshire, it's about avoiding actions they'd regret later. And Buffett believes Berkshire's insurance operations under Jane since '86 are unique and very hard to copy.
That's a big advantage.
It's a huge one.
Advice for young investors came up. Someone wanting to develop their own philosophy.
Buffett's advice started with people. Surround yourself with those you respect. Aim to have them as friends. Align with like-minded individuals as you go through life. The importance of that grows over time.
Learn from wise people, not just copy wealthy ones.
Exactly. And learn and experiment on your own. Find meaningful work, especially if money isn't the immediate driver. Spend time with insightful people, like Charlie Munger was for him.
Seek out those who go the extra mile. Share success with them.
And be persistent in finding them. He used his Geico story again. Persistence led to meeting a key person. And reciprocate. Help those who help you. Show gratitude through actions.
Appreciate luck, like being born in the U.S. without guilt. Avoid unethical situations.
Definitely. Be careful about who you associate with, what businesses ask you to do. Standards vary by industry.
He came back to his love of investing, a passion that lasts. Find work you could do forever that you genuinely enjoy. Take the long view.
Right. And he praised people like Tom Murphy, who could see potential in others. Find people like that, learn from them, grow with them. Successful people are common, he said, but those who lift others up are rare.
He mentioned Berkshire's long-term people, Gottsman, Scott, Abel, as examples to learn from.
And finish with that observation, happy people who love their work tend to live longer. Maybe it's the Coke.
Huh, maybe. Okay, Q1 2025 cash reserves increased significantly. Why?
Buffett acknowledged the buildup higher than the previous year, mentioned market instability after April, and the roughly $10 billion they did invest recently.
But $10 billion is small for Berkshire now.
Relatively, yeah. In the context of their size and history. He pointed out they've often waited for long stretches, maybe even half the time historically. He threw out examples of huge market drops, like the Dow in '29.
So current fluctuations aren't seen as that dramatic.
Not from his long-term view. So many trading days, so many transactions. He's seen the Dow go from 240 to 30, and recently from 24,000 to over 41,000.
A 15% drop, while noticeable, isn't world-ending in his eyes.
Not a fundamental change. He expects periods like that over the next 20 years. The market is unpredictable, huge mistakes happen, surprising things are normal.
Key advice, don't panic.
Don't panic, don't react with extreme fear to short-term moves. People get emotional, but don't jump ship impulsively.
Someone from Shanghai asked about navigating personal low points. How did Buffett respond?
He was quite grounded, acknowledged everyone has highs and lows, though his own issues have been relatively minor. He mentioned Charlie Munger faced significant lows. It's part of life.
The main message was reassurance. A low point isn't the end.
Right. You won't die, he said, basically. Don't dismiss hardship, but remember, many great people face adversity and recovered. But also, don't just chalk everything up to random luck.
Health problems are a different level of challenge, though.
He acknowledged that. But put things in perspective, we live in a relatively good era compared to history. Focus on the good, accept bad things happen, but a good life is still possible after tough times.
He sounded personally fortunate, content,
Yeah.
enjoying his Coke in '94.
Yeah. He touched on limited career spans in some fields, the choices you make. Said you don't need excessive exercise for health.
Encouraged the questioner to focus on the positives, being there, being healthy, learning from smart people. Said their current situation is lucky by historical standards.
It's a good dose of perspective.
Autonomous vehicles. How will they impact Geico and insurance? Liability shifts.
Ajit Jain thinks that even full autonomy might not fundamentally change insurance. Why? Because most insurance now is based on driver error frequency.
It's uncertain if autonomous cars will mean fewer accidents, less insurer liability.
Exactly. Geico's ready to adapt when it becomes widespread, but the current model still relies on driver error rates.
Buffett brought Munger's view in the game of war. Competition stays constant despite tech.
Right. You can't always hit home runs. Errors are possible. Human brains solve problems. Will auto insurance change fundamentally? Big question.
We don't have much real-world data yet on fully autonomous long-term impact.
Not over 100 years, no. And people still enjoy driving. Plus, there are bigger goals, like not destroying the world. He touched on global threats, leadership, Einstein's EMC tech.
Unforeseen consequences of tech, like nuclear weapons being irreversible.
Yeah. The world changes, life is better now for many than 100 years ago, but human nature, destructive potential, maybe not so different.
He sees the auto industry insurance evolution as more manageable than, say, shifting from textiles.
And reminded everyone we live in fortunate times, enjoy life, but understand the changing insurance game. Basic principle. If you don't know how to swing, don't play golf. Apply your expertise.
Jain added more factors to product liability for autonomous tech, rising repair costs with advanced systems.
Good points. Buffett then gave those cost comparisons, $40 average policy in 1950 versus $2,000 plus today, even with fewer fatalities per mile. Safer driving, but vastly higher costs.
Predicting big shifts is hard. Other industries, like energy, are evolving too. Need to find the action point with the best odds, even as rules change.
He mentioned Q1 earnings insurance down a bit from a strong but volatile prior year. Lower prices, higher risks this year factor in.
But Berkshire has those unusual advantages in insurance. Hard to copy.
Right. Mentioned someone named William joining to underwrite large amounts, stressing pricing discipline. Investment income is stable, around $40 billion expected annually, allowing reinvestment.
Investment durations are shorter, but not expecting major negative effects. Railroad earnings improving. BHE is a terrific asset.
Energy sector had a good year, no major problems, boosting earnings. General businesses were mixed, 21 up, 28 down. But overall, strong financials, big cash flow, lots of opportunities for the patient.
Munger always said there were plenty of good ideas over 50 years. Need to read reports carefully, listen to trusted people.
Patience yields opportunities. Berkshire's float is probably the biggest anywhere. Expect chances over the next 50, 100 years, even with bad underwriting years, using that float.
Jain noted the cost to float was actually negative recently, releasing cash. Different thinking needed for operating diverse businesses versus just P&C.
And the final slide. No stock buybacks this year. That 1% federal excise tax hits Berkshire hard because they buy back so much. Contrasted with Tim Cook buying back $100 billion at Apple, benefiting long-term holders.
Deep reading, understanding that's key to boosting success odds. Berkshire's being conservative on buybacks due to the fee. And then they noted time was running short.
Right.
Buffett then gave a plug for the documentary Becoming Warren Buffett.
Yeah, on Amazon Prime. No financial incentive, he said. Just thought it was a good look at American history from about 50 years ago. Recommended U.S. citizens watch it.
Then the conversation turned personal, reflecting on Charlie Munger, a question about a story that comes to mind.
Buffett actually deferred to Greg Abel on that, asking for his perspective on learning from Munger.
And Abel's thoughts.
Called Munger an incredible mentor, someone who will be forever remembered, like a great father and coach. Said he was always learning from him, even in their recent conversations.
He recalled his first meeting with them both during the Mid-American Energy acquisition as unforgettable.
Shared a story about a Saturday meeting, Buffett instantly grasping complex financial details like derivatives. Munger always stressed understanding hidden risks, finding out Buffett's real concerns beyond the usual deal points.
Like discussing energy crises, but focusing on actual profits made and the real risks, not just speculation.
Buffett jumped back in then, emphasizing spending serious time reading financials, looking at trends over time, figuring out what's not being said. He added he doesn't care about being remembered himself, unlike maybe Katharine Graham.
He called Munger the ideal teacher, deep, not superficial, genuinely curious, open to opposing views. Though he also said his father was a huge teacher, too. Leverage those learning opportunities around you.
Right. Then the focus shifted squarely to Greg Abel. His philosophy on capital allocation as the incoming CEO facing those high Buffett-Munger standards.
What was Abel's approach?
He stressed understanding Berkshire's history, the strong ethical culture. Shared values among capital allocators are key. The approach considers management quality and risk.
Protecting Berkshire's reputation is paramount.
Absolutely. Invaluable. Ethics first in investments and operations. He echoed Buffett and Tom Murphy on understanding the income statement.
Sees the huge cash pile as a strategic asset. Needs to be allocated to withstand tough times without outside help.
Exactly. Risk management across all businesses is crucial. Operating companies need to generate enough cash flow. Adequate resources on the income statement are vital.
And the core investment philosophy stays the same.
That's what he affirmed. The same 60-year focus on finding good opportunities, insurance, and non-insurance, letting businesses develop when chances arise, managing capital for profitable entry and exit.
Looking for whole companies or parts of them, like the $10 billion deployed recently judged good value for the risk.
Right. And open to minority stakes, too, if the long-term vision, 5, 10, 20 years, makes sense. Doesn't matter if it's 1% or 100%.
Critical need. Understand the company's economic path and the downside risks. That philosophy remains consistent.
Buffett then added a broader point about national needs, like upgrading the power grid, analogous to the interstate system, needs government leadership.
Challenge of coordinating across 40, 50 states.
Yeah.
Different from wartime mobilization.
Yeah. Berkshire has capital and knowledge, but needs transformations that make sense for government, public, and Berkshire. Unsure of the best way, but needs trillions leveraged effectively. Probably requires government-private partnership, like the interstates.
Abel then specifically mentioned electricity sector opportunities to meet long-term demand. Needs huge capital, managed risk.
Buffett reiterated the need for federal involvement, navigating state regulations. Again, the interstate system example slow without collaboration. Need to harness national capabilities. Big challenges for the next generation.
A 14-year-old from Hong Kong, whose dad is a longtime Berkshire holder, asked for advice on becoming a knowledgeable investor and maybe working at Berkshire.
Buffett passed that one to Abel for the future outlook.
Abel's advice.
Agreed with the dad, hard work is key for owning the stock and for a good life. Emphasized ethics, dedication. Said diligent effort usually leads to joy, like Buffett described, and he hoped to see the young attendee on the Berkshire team someday.
Wildfires and utilities. How does Berkshire protect its companies from that growing risk?
Buffett was candid here. Admitted past mistakes, specifically the Pacificor acquisition in 2000, flawed decision by him, Walter Scott, others, led to unexpected huge wildfire liabilities across 7 starts.
Said operating utilities is inherently tough, needs good management, and the wildfire issue is getting bigger.
Greg Abel confirmed it's persistent, risks likely increasing yearly, can mitigate but can't eliminate risk entirely. Ongoing work on asset management, maintenance, strategic investment to reduce ignition risk, strengthen the system.
It's widespread, too, not just California. Texas, Nebraska storms. Changing climate.
Right. They're improving management techniques, but outages are still possible. He talked about lessons from a big 2020 Pacific Power incident. They didn't shut down proactively then to keep services running.
Now they think more carefully about when to de-energize lines near fires. To prevent more damage, protect people.
Exactly. Managing risks to stop fire spread, it's a constant balancing act.
Then there was that persistent shareholder from Poland, living in Chicago now.
Ah, yes, the one who recounted Buffett's 1951 trip seeking insurance knowledge, paralleling her own determination writing to him in 2011 asking for a meeting.
She mentioned his comment about limited days left, pressing matters, noted 5,000 days had passed since her request, still inspired by his persistence.
And respectfully asked again for just 1 hour in his office. Acknowledged his schedule, her unique background, the support of the 40,000 attendees.
Buffett's response.
Acknowledged her detailed history of his life, with some humor, then offered a tip from his youth. Seeking a meeting. Offer a very short time, like 10 minutes. Let them extend it.
He reminisced about coal miners wanting to talk competitors, the rise of standardized IR departments. Said he prefers direct info. Tons is public on Berkshire anyway.
And ultimately, individual interviews are just impractical with so many shareholders. Appreciated her efforts, but declined the meeting due to logistics.
A question came up about Berkshire Hathaway Energy's valuation, specifically the staggered acquisitions of Walter Scott's family stake. Seemed like a big jump in value quickly.
Buffett acknowledged the uncertainty around Pacificor's potential losses. Noted states generally want utility upgrades, performance was decent, but Munger always stressed needing deep operational knowledge.
Unforeseen issues popped up in the Pacific Northwest, beyond just Pacificorp, reflecting broader trends.
Yeah, unexpected decisions, altering valuations. The utility business has changed dramatically over 70 years.
Greg Abel decided divesting wasn't the answer. It's a long-term utility asset like real estate, but potential for big losses exists.
Decisions were based on understanding at the time, but the view of the utility business is different now. California fires, societal trends are indicators. Values change, not always up.
The deal with the Scott family was done at an acceptable price then, like buying more stock over time, but the industry's inherent value is seen differently now.
Berkshire is less keen on buying utility businesses today than years ago, and the principle of getting others to share the financial burden when huge capital is needed applies. Still hope for good performance, though.
What about future earnings power for Berkshire overall? Up or down this fiscal year?
Buffett hinted utility income might be impacted somewhat. Said M&A doesn't always affect earnings directly, but the $10 billion deployed this year implies they saw value.
Merger decisions are very situational. Market conditions, investor sentiment matter. Some might be pessimistic now.
Right. Buffett even reflected on his own past missed chances due to anxiety, even with good prospects. Said many opportunities are tied to human psychology.
He described his own risk approach avoids physical risks, like tight ropes, but less fearful financially than others might be.
Views a big drop in Berkshire's value as a potential very good opportunity. Contrasts with panic reactions. Said he doesn't react emotionally to stock prices, stresses rational decisions.
Expects continued long-term strengthening of earning power.
Yes. Through prudent capital retention, daily decisions on managing and allocating profits. Pointed out power dynamics in business create opportunities, like upstream versus downstream. Intense selling pressure can also create good entry points.
Someone brought up the big tech companies, Microsoft, Apple, Amazon, holding vast capital, investing heavily in AI. Has Buffett's view of them changed since 2017?
He acknowledged their huge earnings come from huge capital investment, which is necessary for any business. Used Coke's bottling as a capital-intensive example.
Highlighted insurance, P&C, as unique capital guarantees future promises, but can be invested long-term.
Views Apple's business as sound, stock as good long-term investment. Noted Apple repurchasing shares suggests it doesn't need endless capital for operations.
Future stock prices, unpredictable. Observed some get rich managing others' capital effectively?
Right. Touched on the impact if everyone charged a 1% management fee. Asset managers can earn big fees regardless of performance, using other people's capital offsets constraints.
Said he and Munger historically didn't criticize capital management structures much. Realized using others' capital, sharing losses, is advantageous, though open to abuse.
Greg Abel added thoughts on Canada's tendency for more government intervention. Effectiveness depends on societal choice. Saw varied capital mechanisms globally, shaped by underlying forces.
Buffett reiterated the U.S. track record of innovation, capital deployment by Rockefeller, Carnegie, etc. Said it's logical for managers of others' capital to act in their own interest.
Called U.S. capitalism a powerful driver, unprecedented success, unique blend. Use the churches versus casinos, analogy, different appeals, functions, motivations, outcomes. Hard to judge choices people make for livelihood, different life expectations. Important to consider the legacy left for future generations.
The 13-year-old from Florida asked how high school courses relate to future investment success.
Buffett really emphasized the lasting impact of teachers, formal ones, future bosses, importance of actively seeking out and learning the right things.
Share his own luck, father in the business. Learned by observing, reading books early, explored libraries in Omaha and New York.
Contrasted his reading with Munger's more voracious style, stressed curiosity, finding empathetic teachers, recalled influential ones from high school, college, enjoyed being around them, lasting impact.
Compared it to getting hooked on a TV series, but he spent maybe 10,000 hours reading business investment stuff. Learned profoundly from Ben Graham, The Great Bridge Book.
Learning is individual. Find your own path. Identify teachers, people who resonate. Learning feels natural. His experience with Graham at Columbia, treated like a thun, dedicated mentorship.
Advice. Observe curiously. Seek inspiring, supportive people. Mentors were key for him, at least 10. Many people will help young folks seeking guidance.
Said personal relationships mattered more than institutions in his own schooling. Keep working hard, you'll find people for meaningful collaboration. Repeated the Geico persistence story.
Help those who help you. Show gratitude via actions. Appreciate good fortune, like being in U.S., without guilt. Leverage advantages. Avoid unethical businesses, people.
Investing is appealing as a lifelong pursuit if you genuinely enjoy it, regardless of money. Take the long view. Praise Tom Murphy's ability to see potential in others, find people like that. Rare to find those who succeed and lift others.
Mention Berkshire's long-term people again. Gottsman, Scott, Abel, learn from them. And the anecdotal link. Happiness, loving work, maybe living longer, and drinking Coke. What about government bureaucracy? Would a Department of Government efficiency help or hurt the U.S. long-term?
Buffett called bureaucracy an incredible, contagious problem, especially from a capitalist view. Thinks most systems, including Berkshire, could be streamlined.
Government lacks a real oversight body for itself. Worries about unknown future monetary policies.
Concerns about politicians making promises but acting inconsistently. Politicians with money but no creditworthiness are problematic. The core issue, controlling national income expenses, remains unresolved.
Few societies are immune to deficits, though some manage better. Current U.S. deficit situation. Unsustainable long run.
Could reach a point where it feels uncontrollable, efforts abandoned. Praised figures like Paul Volcker for preventing worse outcomes. Historical evidence shows severe inflation is bad.
Buffett wouldn't take on fixing the U.S. budget imbalance. Current deficit, around 7%, feels unsustainable, uncontrollable. Critical work neglected by Congress.
Acknowledged the U.S. has many problems, but also huge talent. Problems likely evolve slowly. Systems have incentives, checks, balances leading to good and bad. Successful companies face similar issues, solved by rules.
A hypothetical from Germany. Creating a resilient capitalist nation in 1770 with Ben Franklin. What principles?
Buffett felt Franklin was far more capable, would have had better ideas. Praised Franklin's ingenuity, long-term vision, like his bequest to Philadelphia. Wouldn't want to hinder Franklin's thinking.
Franklin focused on urgent problems then, to enable future success. Vast difference between 1770 concerns and today's 8 billion people problems.
U.S. system relatively successful, but can't just educate the world on how to run things. Giving unsolicited advice historically causes resentment. Focus on designing systems that win humbly. Avoid inventing tech that destroys planets and becomes uncontrollable. Nukes.
Need to help others. Eliminate harmful elements. Use Iran as example of irreversible consequences. Perspective from his congressman father understanding atomic bomb gravity.
Today's society beyond Franklin's imagination. Generally moving right direction on revolutionary principles. But modern problems Franklin might struggle with. WMDs, creating winner-loser.
Reiterated U.S. is best place, now is best time. Contrasted with past hardships, medicine, travel. Ongoing responsibility to maintain good conditions, stability, protection from government harm. Profiting via rule of law, increasing overall prosperity is a sound social system. Berkshire's hands-off approach to subsidiaries. Greg Abel was asked to describe the current approach.
Abel called his experience since 2018 fortunate, learning the businesses, deep respect for Buffett's knowledge, positive interactions, Buffett sharing insights, ideas, opportunities.
Open communication, discuss frameworks with Buffett, leads to sound operations, managers have autonomy.
But significant opportunities or industry shifts. Discussed with Buffett to assess pursuit, risks, high engagement among managers, consistent autonomy for managers in their areas.
Buffett carefully picks managers who know their industries deeply. Use Geico example value of discussing issues with experienced leaders, learning from the past. Management team is active, engaged, positive.
Buffett agreed with Abel. Long working relationship, enjoyment. Playfully wished he was an artist sometimes to avoid pressure, but likes security of success. Stressed ownership, performance. Abel demonstrates that.
Contrasted managers thriving on autonomy versus those needing direction. Talented people might leave if micromanaged. Abel acts independently but is receptive.
Managerial roles need different attributes. Not everyone's suited long-term. Leadership behavior impacts organization, quality, positive and negative is contagious. High-level people must act responsibly, not manipulate rules. Advised against actions with unintended negative results. Expressed confidence in Abel's judgment, performance.
Question from an Omaha high school student. Berkshire Hathaway Energy's stance on carbon, renewables, given climate change, coal's perception.
Greg Abel called it critical for BHE's future operations. National importance of energy support considered during acquisition. Clear understanding. Operate per federal state law and public policy.
Recounted early 2000s Iowa talk. Electricity shortage. Need to address Midwest energy. Mostly coal then. Need new concepts. Dialogue. Challenges ensuring long-term reliable supply. Debate then. coal versus natural gas.
BHE started Iowa's largest wind projects alongside building 3 new coal plants. Pioneering wind aligned with national policy. Renewables must meet national standards.
$16 billion invested in Iowa, aligned with state-federal policy, collaborative effort, created opportunity to retire 5 older coal units later.
Big achievement. Retired units while keeping reliable service, stable costs, profitability, low-cost leader. 5 remaining coal units needed for system stability now.
Committed to respecting processes, collaborated with each state on their energy blueprints. Preserve best outcomes, acknowledge challenges, consistent commitment. Work with stakeholders, meet customer needs, follow law, align with federal guidelines.
The healthcare venture with JP Morgan and Amazon, why did it end? Thoughts on long-term value, U.S. healthcare reform.
Buffett pointed out U.S. healthcare spending nearing 20% GDP. Huge jump from 5% in 1960, diverges from other countries. Called the venture an experiment. Finding: they didn't have the answers.
Liken healthcare to a tapeworm on the economy. Deeply embedded problem disliked by many. Reality. Even huge players like JPM, Amazon couldn't shift that 20% allocation, plus 6-7% government spending.
Hard to change entrenched system with powerful stakeholders, providers, etc., even wanting to save lives. Canada, UK also face cost challenges.
U.S. is destination for complex treatments, but little overall reform progress. Believes government intervention eventually needed. Diminished enthusiasm for changing 20% of GDP, not malice, just sale of challenge.
Conclusion by the 3 partners. Lacked insights into perspectives of 300 Manor people, doctors, hospitals. Fundamental change unlikely.
Recalled his dad's failed 1948 campaign despite supporting healthcare reform shows deeply held beliefs of medical pros. Acknowledged healthcare workers' pandemic selflessness, but costs remain extraordinarily high versus other nations.
U.S. wealthy enough for approaches others can't afford. But public opinion, political will needed for change. Existing system deeply rooted, resistant.
Buffett personally pessimistic, entering and exiting venture. Valuable learning, no financial loss for Berkshire. Challenge of changing government. Elected officials face tough choices, need reasons to support things they might oppose.
U.S. process flawed, but maybe better than elsewhere. Significant reform incredibly hard. Key problem: easy to spend, hard to cut budgets. Constraints on elected officials wanting re-election. Perspective from political family observing behaviors.
Progress continues despite challenges. Situation better than 200 years ago. System not total failure, but big change is exceedingly difficult.
A first-timer from Taiwan asked, under Abel, will Berkshire focus more on investment or operations?
Buffett joked, calling Abel Mr. Abel, implying operations are tougher than managing investments from an office. Acknowledged his own luck choosing friends, working with people he likes, rare privilege.
Positive experience with current managers. Has more flexibility choosing daily activities than typical operators. Prefers not being top operating exec due to some aspects. Values running company in way one enjoys.
Then the big news drop. Berkshire board meeting next day. 11 directors, including Howard and Susan Buffett. Stated intention: recommend Greg Abel as next CEO. Transition by year end.
Board gets time to consider. Ask questions on structure, transition. Decision, action at later board meeting. Public announcement when official. Emphasized. Serious matters start of power transition. Thanked audience for supporting his decisions.
Added its most economically sound decision. Believes Berkshire's prospects even better with Abel. Buffett will continue evaluations, commentary as possible. Views this as right time for transition. Will help board considering investments too. Reiterated his huge personal stake, belief in this decision.
Concluded thanking attendees for 2025 meeting. Acknowledged audience's enthusiastic reaction, perceived endorsement.
So wrapping up the key takeaways for you. That nuanced view on patience really stood out. Wait for the right pitch, but swing fast when it comes.
Right. And the deep long-term commitment in Japan. Plus that disciplined yet ready to pounce approach with the cash.
And their strategy on AI, adaptive, watchful, not jumping on the bandwagon immediately. Definitely things to keep thinking about.
Absolutely. Hearing from Buffett and Abel directly gives you such a valuable framework for looking at business and the economy. It's like getting the Cliffs Notes from the masters.
We really hope you reflect on these points. And hey, if you're really keen, the full transcript of the meeting is out there for an even deeper dive.
Fairly worth considering.
Yeah.
So here's a final thought to chew on. As Berkshire enters this new era under Greg Abel, what other bedrock business principles, the ones that have guided companies for ages, might get challenged or even rewritten in the coming decades as things keep changing so fast?
Thanks for joining us for this deep dive into the Berkshire Hathaway shareholder meeting.
Until our next exploration.